There is a chart that a small number of professional traders are staring at right now, and most of them are not talking about it publicly. It is a wedge, a narrowing triangle of price action in gold that has been compressing for months, tightening like a spring, and every wedge like this one in modern financial history has ended the same way. Not with a whimper, but with a decisive break in one direction. A break that decided the next several years of returns for anyone holding hard assets. We are close to that point now, and silver, gold's more volatile, more industrially tied cousin, is sitting on its own breakpoint that historically has told us which way gold is about to go before gold itself moves. This is not a video about hype, and it is not a prediction dressed up as certainty. It is a walk through the evidence, the history, and the economic logic that is bringing us to this moment, so that by the end you understand not just what a wedge is, but why it exists at all, why gold and silver behave the way they do inside the machinery of interest rates, debt, and human psychology, and what a thoughtful long-term investor does with that understanding, regardless of which way the price ultimately breaks. Before we go further, I want to ask you something, because where you are watching from actually matters for the story. Gold and silver are global assets, but the pressures driving them look different depending on which side of the world you are standing on. So take a moment and comment below where you are watching from, and let me know honestly whether you personally are holding gold, holding silver, or sitting mostly in cash right now. I read these, and it helps shape how I think about what people actually need explained. Now, let's build this properly from the ground up. To understand why a wedge in gold's price chart matters, you first have to understand what gold actually is, because most people think of it as a commodity, something like copper or oil, priced by supply and demand for jewelry and electronics. That is a shallow way to see it. Gold has functioned for over 5,000 years as something far more specific, a monetary asset that cannot be created by decree. Every currency in human history that has been backed by nothing but government promise has eventually been devalued, sometimes slowly, sometimes catastrophically. Gold's entire value proposition rests on the fact that no central bank, no finance ministry, no legislature can vote more of it into existence. When trust in paper promises rises, gold tends to sit quietly doing very little, and investors barely think about it. When trust in paper promises erodes, gold becomes the place capital retreats to, because it is the one major asset class that is nobody else's liability. That single fact that gold represents ownership without counterparty risk is the thread that runs through everything else we're going to discuss today. Now let's talk about why that trust in paper promises has been eroding, because this is not an accident or a mood swing among investors. It is the direct mechanical result of decisions made by monetary authorities over the past 2 decades. Since the 2008 financial crisis, central banks around the world, led by the Federal Reserve, have relied on an expanding toolkit of extraordinary measures, near zero interest rates for years at a stretch, and large-scale asset purchases commonly known as quantitative easing to keep economies from collapsing under the weight of debt. These tools were originally framed as temporary emergency measures, but temporary measures have a way of becoming structural habits, because once an economy becomes dependent on cheap borrowing costs to service its existing debt, raising rates back to historically normal levels becomes politically and financially painful. This creates what economists call a debt trap. The more debt a government or economy carries, the more sensitive it becomes to interest rate increases, and the more pressure there is on the central bank to keep rates low, even when inflation would normally call for higher rates. The United States federal debt has grown from roughly $10 trillion in 2008 to over $34 trillion today, and the interest expense alone on that debt has become one of the fastest growing line items in the federal budget. This is not a partisan observation, it is arithmetic, and arithmetic does not care which political party is in office. This is where inflation enters the picture, and it's worth explaining what inflation actually is at a mechanical level, because most people experience it only as rising prices at the grocery store without understanding the plumbing behind it. Inflation in its most basic form is a decline in the purchasing power of currency relative to goods and services, and one of its primary drivers is the expansion of the money supply relative to the real output of an economy. When a central bank creates new currency, whether through direct printing or through the banking system's credit expansion, and that new money chases a relatively fixed supply of goods, prices rise. Governments have historically found this outcome convenient because inflation effectively erodes the real value of existing debt. If a government owes $10 trillion and inflation cuts the purchasing power of $1.50 over a decade, that debt becomes, in real terms, dramatically easier to service. This is sometimes called financial repression, and it has happened before in modern history, most notably in the period following World War II, when the United States and Britain used a combination of low interest rates and moderate inflation to quietly reduce enormous wartime debt burdens over roughly 2 decades. Investors living through that period who held only cash and government bonds saw the real value of their savings decline steadily even while their account balances looked stable on paper. Gold, on the other hand, held its purchasing power over that same span because it cannot be inflated away. Now, let's bring in the bond market because bonds and gold are in constant conversation with each other. And understanding that conversation is essential to understanding the wedge we started with. A government bond is essentially a promise: lend me money now and I will pay you back later with interest. The problem is that when investors start to doubt whether that promise will hold its value because they suspect the government will simply inflate its way out of the debt, they demand higher interest rates to compensate for that risk. This is what we've seen happening periodically in the bond market over the past few years, with long-term treasury yields becoming more volatile and at various points rising sharply even as the Federal Reserve tried to guide short-term rates lower. When bond yields rise because of genuine growth optimism, that's typically bad for gold because investors can earn a decent, safe return elsewhere. But when bond yields rise because of inflation fears or doubts about fiscal sustainability, that is historically very good for gold because it signals that the entire foundation of the paper financial system, the government's own IOUs, is being questioned. Telling these two scenarios apart is one of the most important skills in macro investing, and it is precisely the kind of distinction that is compressing gold into the wedge pattern we are discussing, because the market currently cannot decide which story is true. Let's talk about liquidity next, because this is the piece most retail investors miss entirely. Liquidity in the macroeconomic sense refers to the availability of money and credit flowing through the financial system. When central banks expand their balance sheets or when banks lend freely, liquidity is abundant, and that abundance tends to lift almost every asset class at once: stocks, real estate, cryptocurrencies, and yes, gold. When central banks tighten withdrawing liquidity through higher rates or by shrinking their balance sheets, the opposite happens. Assets across the board come under pressure as the pool of available capital shrinks. Gold occupies a unique position in the cycle because it benefits from loose liquidity conditions when they eventually translate into inflation fears, but it can also benefit from tight liquidity conditions when they translate into financial instability and safe haven demand. This dual nature is part of why gold's price action can look confusing to people trying to trade it like a normal risk asset. It isn't one. It is closer to a barometer of trust in the entire monetary system, responding to both extremes of the liquidity cycle for different reasons. This brings us to one of the most significant and frankly underreported stories in the gold market over the past several years: central bank buying. According to data published by the World Gold Council, central banks around the world have been purchasing gold at a pace not seen in decades, with net purchases exceeding 1,000 tons annually in some recent years, a level roughly double the average pace seen in the prior decade. This is not retail speculation. These are sovereign institutions, the same institutions that manage national currency reserves, deciding to hold a larger proportion of their reserves in physical gold rather than in U.S. Treasury bonds or other paper assets. Countries like China, Russia, India, Turkey, and Poland have been particularly aggressive buyers. There are multiple reasons behind the shift, but one stands out above the others: the freezing of a portion of Russia's foreign currency reserves by Western nations following the invasion of Ukraine in 2022 sent an unmistakable signal to every other government holding large dollar reserves. It demonstrated in a very concrete way that dollar-denominated assets can be frozen or restricted for geopolitical reasons. Gold, by contrast, sitting in a vault under a nation's own physical control, cannot be frozen by a foreign government's decree. This is a structural geopolitical driver of gold demand that has nothing to do with short-term inflation expectations and everything to do with a slow, deliberate diversification away from dependence on any single reserve currency. When you understand that sovereign buyers with multi-decade time horizons are steadily accumulating, you start to see the wedge differently, not as a random technical pattern, but as the visible surface tension of a much deeper shift happening beneath the market. Now, Let's talk about currency strength, because oil price is quoted in dollars. And the strength or weakness of the dollar itself plays a constant role in gold's movements. The US dollar has served as the world's primary reserve currency since the Bretton Woods Agreement in 1944. And even after that agreement's gold backing provisions were abandoned by President Nixon in 1971, the dollar retained its dominant role through the depth of U.S. financial markets, the size of the U.S. economy, and global trust in American institutions. When the dollar strengthens other currencies, gold priced in dollars tends to become more expensive for buyers using other currencies, which can dampen demand and pressure prices lower. When the dollar weakens, the opposite occurs. Over the past several years, there has been a slow but persistent conversation happening among economists and policymakers about de-dollarization. The idea that an increasing share of global trade and reserves might gradually shift away from exclusive dollar dominance toward a more multi-pillar currency system. This is not a prediction that the dollar will collapse. That would be an overstatement not supported by current evidence given the dollar's continued dominance in global trade invoicing and reserve holdings. But the direction of the trend, even at the margins, matters enormously for gold, because gold tends to benefit from any structural erosion in confidence around a single dominant currency, even a gradual one. Let's pause here and talk about why all this matters for human behavior, not just abstract economics, because markets are not spreadsheets. They are crowds of people making decisions under uncertainty, and understanding the biology behind those decisions explains why gold's wedge patterns tend to resolve so violently once they finally break. When investors face uncertainty, the brain's amygdala, the region responsible for processing fear, becomes highly active, triggering the release of cortisol, the primary stress hormone. Elevated cortisol impairs the prefrontal cortex, the part of the brain responsible for rational long-term decision-making, and shifts behavior toward short-term instinctive reactions. This is why during genuine market panics, even experienced investors often make decisions that look irrational in hindsight, selling at the bottom or buying at the top, because their biology is temporarily overriding their training. On the flip side, during periods of rising asset prices, the brain's reward system releases dopamine in anticipation of further gains, creating a feedback loop where each price increase makes the next purchase feel more urgent and less risky, even when objectively valuations are becoming more stretched, not less. This dopamine-driven momentum is what fuels blow-off tops in markets, and cortisol-driven panic is what fuels capitulation lows. A wedge pattern in this light is really a visible record of accumulated uncertainty, a market full of investors whose amygdalas and dopamine systems are pulling in opposite directions, unable to commit fully to either fear or greed, compressing price into an increasingly narrow range until the tension becomes unsustainable and one emotional state finally overwhelms the other. Let me tell you about a woman named Elena Ruiz, 47 years old, a dental hygienist in Phoenix, Arizona. This is a fictional story, but it reflects a pattern I've seen play out in real investor behavior many times. Elena began buying gold coins in small amounts back in 2019, not because she had any sophisticated macro thesis, but because her grandmother, who had lived through hyperinflation in Argentina decades earlier, had always told her that paper money could disappear overnight, but gold in your hand never would. Alana treated it as a modest form of insurance, allocating around 5% of her savings and largely ignored the day-to-day price swings. When gold surged sharply in 2020 during the pandemic, she felt validated but didn't sell because her grandmother's lesson had never been about timing a trade. It had been about preserving wealth across a lifetime. When gold pulled back in 2021 and many newer buyers who had chased the rally panicked and sold at a loss, Alana did nothing because her position size had never been large enough to cause her sleepless nights in the first place. By simply holding a modest, disciplined allocation through multiple cycles, she avoided the emotional whipsaw that destroyed returns for people who tried to trade gold like a momentum stock. Her outcome wasn't spectacular, but it was steady. And steady compounded over years is usually what separates investors who build real wealth from those who merely have exciting stories to tell at dinner parties. Contrast that with a fictional investor named Marcus Chen, 31 years old, who worked in software sales and got interested in silver in early 2021 after seeing enormous excitement online about a potential short squeeze in the silver market. Marcus put nearly 40% of his portfolio into silver mining stocks and leveraged silver futures over the course of a few weeks, driven less by an understanding of monetary economics and more by the dopamine rush of watching a fast-moving chart and fearing he would miss out if he didn't act immediately. When the anticipated short squeeze failed to materialize the way online forums had predicted, and silver pulled back sharply, Marcus's leverage positions amplified his losses, and he sold near the bottom of that pullback in a moment of cortisol-driven panic locking in a loss of more than half his invested capital. The lesson from Marcus's story isn't that silver was a bad asset to own. Over subsequent years, silver actually performed reasonably well as part of a diversified precious metals allocation. The lesson is that the size of your position and the emotional state driving your entry determine your outcome far more than which asset you happen to choose. Silver itself didn't fail Marcus, his process did. Now, before we get into the final and most important part of this analysis, the actual mechanics of the wedge and what history tells us about how these patterns resolve, I want to ask you for something simple. If you're finding this kind of grounded, evidence-based breakdown useful, take a moment to like this video and subscribe to the channel because it genuinely helps this kind of long-form economic analysis reach more people who are tired of hype-driven content. And I'd encourage you to stay through to the end because the final insight in this video is going to connect the debt cycle, the central bank buying, the currency dynamics, and the psychology we've discussed into a single coherent conclusion that will change how you look at every future gold and silver headline you encounter. Let's now talk specifically about silver because silver's relationship to gold is one of the more elegant pieces of market logic once you understand it. Silver is often called gold's higher beta cousin, meaning it tends to move in the same direction as gold, but with greater amplitude both on the way up and on the way down. This happens because silver occupies a dual identity. It is simultaneously a monetary metal historically used as currency for thousands of years and an industrial metal used heavily in electronics, solar panel manufacturing, and various green energy technologies. This dual identity means silver's price reflects both monetary anxiety, the same forces driving gold, and industrial demand cycles tied to global manufacturing and the ongoing energy transition. When both of these forces align in the same direction, silver tends to outperform gold dramatically, as it did during certain stretches of the 1970 seconds and again in 2020. When they diverge, silver's price action can become choppier and less directional than gold's. The gold to silver ratio, which measures how many ounces of silver it takes to buy 1 ounce of gold, has historically served as a useful gauge of market sentiment. When that ratio becomes historically stretched, meaning silver is unusually cheap relative to gold, it has often, though not always, preceded periods where silver catches up sharply. This is part of why some analysts watch silver's own technical breakpoint as a leading signal for what gold might do next, because silver's dual demand drivers can sometimes reveal shifts in industrial and monetary sentiment before gold's more purely monetary price action catches up. Let's now step back and look at the historical parallels that give this current moment its weight because markets rhyme even if they don't repeat exactly. In the early 1970 seconds, the United States faced a combination of persistent inflation, the abandonment of the gold-backed dollar system, and a series of geopolitical oil shocks. Gold, which had been fixed at $35 an ounce under Bretton Woods, was allowed to float freely and rose to over $800 an ounce by 1980, an increase of more than 20-fold over roughly a decade. Though that rise was neither smooth nor uninterrupted and included a brutal 50% drawdown in the mid-1970s that shook out a large number of investors before the larger move higher resumed. That drawdown is a crucial detail because it illustrates that even structural bull markets in gold are not straight lines, and investors who require constant upward price action to maintain their conviction are poorly suited to holding monetary metals through a full cycle. In 20